This video is going to give you a solid introduction to the balance sheet in accounting. I'm going to explain what it is, how it's all laid out, and then we're going to build ourselves a balance sheet from scratch using Google Sheets and 6 example transactions. Hello there, welcome back to the channel. I'm James, this is Accounting Stuff, and in this tutorial, we're going to cover the balance sheet in accounting. The balance sheet, or statement of financial position, is one of the 3 major financial statements along with the income statement and cash flow statement. So this is a big topic. If you run a startup, then you absolutely must be able to prepare one of these in order to have a hope of getting funding. And on the flip side, if you're ever planning on lending money to or investing in a business, then it's critical that you know how to read and understand the balance sheet, because the balance sheet will give you an impression of the business's financial health, and that will determine how risky the opportunity is for you. And finally, if you're an accountant, then chances are you'll be helping prepare one of these at the end of every accounting period. Over the past few months, I've been posting weekly videos teaching accounting basics for beginners that you can find up here. This video is going to link a bunch of these ideas together, so if you find any parts of this explanation confusing, then I recommend you check those out to cement your understanding and come back to this one if you need to. There will be links in the description below to all of the relevant ones, so feel free to check those out. As I mentioned, I'll be releasing new videos each week, and I aim to cover all of the major parts of the balance sheet, so hit the subscribe button and click on the bell to be notified when those come out. Don't know about you, but I'm itching to get cracking. I mean, what is the balance sheet? Let's find out. A balance sheet looks like this. The way it's presented can vary, but there are some key elements at the core of the balance sheet that the rest of it's built around. Here we have a balance sheet for a business called Craig's Design and Landscaping Services. That's because I took this one from the sample company in QuickBooks Online. QuickBooks Online is the biggest cloud accounting platform in the world, and they specialize in small to medium-sized businesses. So I thought this one would make a good example. If you're thinking this all looks a bit crazy, then no worries. I'm only showing you the finished product. We'll piece together a simpler one of these for ourselves in a moment. Right, I think it's time for a definition. A balance sheet is a snapshot of a business's assets, liabilities, and equity at a single point in time. And that's exactly what we're looking at. We have assets over here on the left, and on the right-hand side, we have liabilities and equity. Beneath both of the headers, we have all of the detail, all of the individual groups of accounts summarized with their closing balances. At the bottom of the balance sheet, we have our total assets and total liabilities plus equity. You'll notice that both of these numbers are exactly the same. That's what we want to see. It's the aim of the game here, because the balance sheet, as suggested by its name, always has to balance. So your total assets must be equal to your total liabilities plus equity. If they don't match each other exactly, then we've got a problem. In the past, people used to make their balance sheets manually, and this was a pain in the ass. You could easily waste hours or even days trying to figure out where the errors were in your workings. But thankfully nowadays, accounting platforms like QuickBooks Online exist. They ensure that your balance sheet always stays balanced. If you run a small business and you'd like to give QuickBooks Online a try, then you'd be doing me a massive favor if you followed my link down in the description. It's an affiliates link, so you'll get access to a free 30-day trial and the chance to support me making more accounting videos just like this one. Check out the video I made up here if you're interested. But if cloud accounting isn't for you, that's okay. You can also support the channel by giving this video a like and sharing it with someone if you think they'd find it useful. But anyway, I promise you that we'd build ourselves a balance sheet from scratch, and I meant it. So here we are, we have a clean slate. We're going to build this balance sheet from the ground up using one key principle: double entry accounting. In double entry accounting, every accounting entry has an opposite, corresponding entry in a different account. Or put simply, stuff the business owns is equal to the stuff the business owes. We accountants call stuff that the business owns assets, but the stuff that the business owes is a little bit more complicated. We use 2 different words to describe it depending on who the business owes stuff to. When a business owes stuff to third parties like lenders, suppliers, and employees, we call them liabilities. However, when a business owes stuff to its owners, we call it equity. So we have assets are equal to liabilities plus equity. This is the basic accounting equation, and it always balances.
Total assets must be equal to total liabilities plus equity.
Now, every financial transaction that a business is involved in affects this accounting equation, so the values of our assets, liabilities, and equity are constantly changing.
But it's possible for us to take a snapshot and freeze their values at a single point in time. When we do that, we're looking at a balance sheet. The thing is though, that these three buckets are far too broad. There are many types of assets, liabilities, and equity, and it would be helpful if we could distinguish between them.
Time for us to hop into Google Sheets and flesh out this balance sheet. We'll begin with assets, and FYI, I'm going to move through this next section fairly quickly because I've made a video covering assets in a lot more detail that you can find linked up here and down below in the description. The same goes for liabilities and equity, so check those out if you'd like some fuller explanations.
Assets are broken down broadly into two main categories: current assets and non-current assets. Current assets are short-term assets that can be converted into cash within 1 year. Some of the most common types of current asset are cash, accounts receivable, supplies, inventory, and prepaid expenses. On the other hand, non-current assets are long-term assets that are used in operations to generate profit. They can't easily be converted into cash, so we expect to hold on to them for more than 1 year. Two common types of non-current asset are long-term investments and property, plant and equipment. It's a similar situation for liabilities. We have current liabilities, which are a business's obligations that need to be settled within 1 year from now. These include accounts payable, salaries payable, taxes payable, and accrued expenses. And we also have non-current liabilities, obligations that aren't expected to be settled within 1 year, stuff like long-term loans. And that leaves us with equity, the final piece of the puzzle. This section works a bit differently to assets and liabilities. We have two broad categories to consider: owner's equity and retained earnings. You can think of retained earnings as profits held for future use.
And this is key because it's the profit in retained earnings that forms the link between the balance sheet and the income statement. Keep that in mind. I'll demonstrate how it works in this next example.
But before we get stuck in, let's do some housekeeping and tidy up this balance sheet by adding some totals. On the left, we have total assets, and on the right, we have total liabilities and equity. These have to match each other exactly because the balance sheet always has to balance. To emphasize this, I'm going to add a little balance checker that'll take the difference between these two cells. This should always be equal to 0. Now that we've built a template for our balance sheet, it's time for some numbers. Let's go back to the scenario of the window cleaning business that we covered in the videos on T accounts, journal entries, and the trial balance.
I'll drop links to all of these down in the description. We're going to use these transactions again so that you can see how all of these concepts fit together. In the interest of saving you time, I'm going to move through these transactions fairly quickly, so if you find yourself getting stuck and wanting some deeper explanations of the debits and credits, then go back and watch those videos on T accounts and journal entries. By the way, on a side note, the trial balance is not the same thing as the balance sheet. If you'd like to see me make a video explaining the differences, let me know in the comments.
There are 6 transactions that we're going to cover, and we'll work through them one by one, filling out our balance sheet template as we go. In transaction number 1, the owner of the window cleaning business makes capital contributions of $100. We're double entry bookkeeping, so this transaction is going to affect 2 accounts: cash and owner's equity. The business's cash is going to be debited to increase it by $100, and owner's equity will be credited to increase that by $100 as well.
Are we in balance? Yes, we are.
In transaction number 2, the business takes out a further $200 loan to fund its activities. We need to debit cash again by $200 to increase it, and credit long-term loans by $200 to increase them too. Transaction 3. The business spends $30 in cash on window cleaning equipment. We credit cash by $30 to decrease it, and we debit our plant, property, and equipment by $30 to increase our equipment. In transaction 4, the business spends a further $50 on cleaning supplies. The payment is made on account. Paying for something on account means that you're agreeing to pay the supplier at a later date. So we debit our supplies by $50 to increase them. And this time we don't credit cash, we credit accounts payable by $50 to increase them instead.
Just a couple more transactions left to go. You've got this.
These ones are going to affect our retained earnings account. Remember, that means our profit held for future use, and it links the balance sheet and the income statement together. I'll show you how this works now. Transaction 5. The window cleaning business makes $150 cleaning windows and uses up half of its cleaning supplies in the process. This transaction is a bit more tricky than the ones we've covered up to this point because there are two parts to it, each with their own double entries. The first thing that we need to do is recognize revenue earned. To do that, we debit cash to increase it by $150. And we also credit revenue to increase that by $150.
But hold up. Where does revenue go? I can't see it anywhere in our balance sheet. We're going to need to jot down an income statement for our window cleaning business.
An income statement is a summary of our revenue earned and expenses incurred over a period of time. So here we have revenue of $150.
Almost there. Next, we need to record the second part of the transaction.
Half of our cleaning supplies were used up on this job, so we can't recognize those as an asset anymore. They now make up our cost of sales, which is a kind of expense and belongs in our income statement as well. In the fourth transaction, we spent $50 on cleaning supplies. So if we've used up half of them, then we need to credit supplies by $25 to decrease them and debit cost of sales in the income statement to increase our expenses by $25.
But our balance sheet still isn't in balance. How can that be? We need to build a bridge between the profit in our income statement and the retained earnings or profits held for future use in the equity section of our balance sheet. So the $125 of profit in our income statement now flows through the retained earnings and balances our balance sheet. One important thing to note, retained earnings and profit for the year don't normally match each other exactly like they do in this example. That just happens to be the case because we don't have any retained earnings from previous years and none of the profits have been drawn out of the business.
That being said, the simplicity of this example is a great way to demonstrate this link between the income statement and the balance sheet. We'll see how that works one more time in transaction 6, where our window cleaning business incurs laundry costs of $20. The payment is made in cash, so we need to credit cash by $20 to decrease it, and debit laundry costs by $20 to increase them in the income statement.
Our profit of $105 rolls up into the retained earnings section of our balance sheet, giving us total assets of $455 and total liabilities plus equity of $455 as well. And our balance sheet checker is showing 0. Good stuff. How did you find that? I didn't want to skip any steps in this balance sheet tutorial. If you've got any questions, let me know down below in the comments or send me a direct message on Instagram @accountingstuff. Hit this circle to subscribe and keep up to date with all of the latest videos. And check out the Accounting Basics playlist over here to explore some of the ideas that we just touched on in more detail. And good luck with those balance sheets.